Now, Peter, that, my friend, is a good trade. Peter bought the CGC's 29 strike call. That is an awesome trade, Peter, for $1.53, and you sold it for $15.50. That's a good trade. It's always fun to make 800% on a trade. CGC was a name. That's really an awesome trade. So CGC, these are kind of trades that I like to do. And the reason we were in that CGC trade, a couple of different reasons, really. So the first reason was Cronos, the purple, against CGC are two highly correlated contracts. So really, really highly correlated contracts. Cronos got an outside investment from Altria. And at the time they got the outside investment, it rallied, but CGC never really rallied. It followed along. So that was the real catalyst for us getting in Cronos. But then what happened, and this is something that I've done throughout my career, and I strongly encourage you to try to do the same or to remember this. So all I did here with S&Ps over SGC. So when the S&Ps fell, and this is something that I've done throughout my career, and I really encourage you to learn this. This is a little bit more of a feel game. But as the S&Ps fell, everything's got a beta of 1. So a beta is how a stock is going to move along with the move of the overall market. So it's just something in trading, and something that I say over and over again, because there's a bunch of things that I say over and over again. But when shit hits the fan and the market's going down, let's say the market's down 10%. When the market's down 10%, what I say and what we say in the business is everything has a beta of 1. So there's nowhere to hide. So it's like Black Monday, 1987. You could have been with the most beautiful, strongest company in the world, but when the market's down 20%, everything's got a beta of 1. Everything's getting dragged down. So when the S&Ps got really hit, that was a great time to try to find companies that were inexpensive relative to something else, or that were strong but just getting dragged down with the overall market. So once the market got dragged down, the entire cannabis sector got dragged down. But if you remember, before cannabis got dragged down, there was plenty of times, and I'll use CGC as the example, but we could use Cronos or any of these. There's plenty of times going back to 2018 that cannabis stocks just got real hot. You know what I mean? Just like these real big run-ups. And so the thought process, and obviously this crazy run-up, but now that it pulled back, we had the run-up, and now it just got dragged lower because, when the market falls, everything's got a beta of 1. So that gave more and more confidence in order to stay in CGC. But then what we also had was Cronos as a relative value trade that was trading way up here. So all those reasons put together is why, someone like Peter could take the trade in January expiration, buy it for $1.50 and sell it for $15. You do a 10 lot, that's $1,500 that you end up making $15,000. That's better than a sharp stick in the eye. Better than any kind of stick in the eye, frankly. Cool. Does that make sense, guys, of why, how I just backed into that? Really, it's overall, and we did the same thing with keys. It's doing research, having a reason for being in the trade. When the market goes down, everything has a beta of 1. Okay, when the market goes down, everything's going to have a beta of 1. Good companies will survive. And then it's just a matter of what I do all the time is when the S&P is falling, like it was, and we get into high volatile periods where I want volatile periods. The more volatility in my mind, the better opportunity. And why is that, guys? Why would I say that more let me phrase it a different way. Do you guys do you feel comfortable when there's volatility in the market? Do you feel uncomfortable? From my standpoint, think about, why would we want more volatility? Why would I want a VIX of 50 rather than a VIX of 10? Besides more opportunity, right? That's the easy answer. But why is there more opportunity? And it's subjective. I just want to get those who want to participate to think. So why would we want more volatility? Okay, and I'll read the answers coming through just for conversation. I'm not looking to embarrass anybody, and there's no right or wrong answer. This is just me kind of off the cuff, but I'm always trying to think about my approach to the market and try to articulate how I trade. So stocks move, mispriced options, more opportunity, bigger moves, more movement, more ways to profit. So all of those are, great. Premiums are bigger to work with. Byron, I like that. Better movement in implied volatility, better price movement in an option. So whenever I'm trading, every single thing that we do comes down to finding your edge. Okay? Everything we do is always, what's your edge? What's the reason that we're doing it? So when I'm looking at the 10-year future contract, many people will sit there and try to figure out different moves and interpret the price action or the behavior, and then they see something and, okay, something should happen after that. So they may look at this and say, the book told me that this is what a head and shoulders looks like. A head and shoulders is forming. That might be a trade idea. Well, that's fine and good, and it looks like this time that may have worked, but that's not edge. Okay, that's just a subjective interpretation. The person who takes a trade like this just says that, hey, I learned something, that somebody told me that if I see this kind of price behavior, I can therefore interpret this kind of move after the price behavior. But that's not edge. If you think about that, it's real subjective. You're really taking somebody's word for it. There's so many different ways that, it took out the left shoulder. Some people say that's not a head and shoulders anymore, whatever. So instead of that, we need to find real edge. And real edge for the 10-year contract, for example, might be S&P's strong, 10-year contract's weak. So that might give you additional edge, just knowing that, hey, when the S&P's rally, historically, bonds have sold off. But specifically in this environment, when the S&P's sold off here, and that doesn't mean it happens every time. It just means, what have you done for me lately? What's going on right now? Right now, when the S&P sell off, 10-year rally, right? So I think it's safe to, infer that when it changes, everything should change. This to me is edge, because once you get the confirmation of the S&P's rallying, if the 10-year hasn't sold off, then edge might be, let's look for a place to sell 10-year future contracts. That is backing in to edge and opportunity. Now back to why we want more movement. Well, the more movement we get is going to increase the amount of trading opportunity that we have. The more edge that we get, really, in my mind, it means that things are more difficult to value. So therefore, experienced traders can find low-hanging fruit or trades that have more edge than would normally have. And that's the same reason why I'm such a huge proponent of trading. That's why I'm a huge proponent of sharing ideas like AUPH as opposed to sharing ideas like Apple.